The head of Russia's central bank has announced that as of February 10, inflation in Russia has reached 10%. Elvira Nabiullina called this figure unacceptably high. According to the central bank's forecast, inflation will peak between April and May 2025, possibly extending into July following the annual tariff indexation tariff hikes. By the end of the year, inflation is expected to settle at 7 to 8%, meaning the target of 4% is now postponed until at least 2026. As a result, private consumption in Russia is projected to grow by no more than 1.5%, while investment growth may grind to a halt entirely.
We are not expecting a wave of bankruptcies. Of course, there are highly indebted companies for whom rising debt servicing costs are a significant factor, substantially reducing their profits. Elvira Nabiullina, governor of the Bank of Russia, from the Moscow Times publication.
Last year, inflation fueled by huge military spending and wage increases due to staffing shortages beat the Central Bank of Russia's updated forecasts 3 times. To curb inflation, Russia's central bank raised interest rates to a record high 21% in 2024. Economists believe that a rate cut is not expected in the near future.
The interest rate is likely to remain at current levels until inflation consistently declines and the economic slowdown becomes not just noticeable but unavoidable. Anton Tabak, economist, from the Moscow Times publication.
Russia's war against Ukraine is becoming increasingly expensive for Russian taxpayers. Russian citizens are feeling the strain as their purchasing power declines. According to Rosstat, prices have risen nearly 10% over the past year and continue to climb. The most significant price hikes have been in utilities due to rising tariffs and food. Major Russian dairy producers have warned retailers of a planned 7 to 10% price increase in February.
According to Ramir's data, the actual increase in consumer prices is between 20 to 30%, which is already galloping inflation. The situation is clear. Inflation is raging in Russia, creating major problems for the Ministry of Finance. The central bank tried to fight inflation using market-based measures. It still believes that a market economy exists in Russia. They raised interest rates, which is a classic market tool, but none of it is working. In December, there was no rate hike, and there won't be one in February either, because it simply has no effect on inflation. But they are moving towards something even worse, directly restricting loans for Russian businesses.
In January 2025, the total volume of loans to households collapsed by nearly 50% compared to January 2024. This has caused a sharp downturn in the real estate market. Developers unable to rely on bank financing have started selling apartments on installment plans, a practice the central bank disapproves. Russians are accumulating debts while their creditworthiness is not formally affected.
This means that loans can be granted to those who, in accordance with the restrictions imposed by the Bank of Russia, are not entitled to them under any circumstances. Banks are failing to assess risks properly, and as a consequence, there is an increase in defaults, overdue payments, and personal bankruptcies. Additionally, the terms of sale are often non-transparent. What appears to be a zero-interest or low-interest loan can actually result in massive overpayments due to hidden fees and penalties. Finally, the financial health of developers is deteriorating, raising credit risks for the construction sector. Maxim Blant, economic analyst for Radio Liberty.
Russia's economy could slip into a technical recession before inflation is brought under control, economists warn. The Kremlin is particularly concerned about a potential increase in oil production in the US and OPEC countries, according to reports from the Russian Ministry of Economy and the central bank, writes Reuters.
The lack of investment now is a lack of GDP growth, lower growth rates in 2 to 3 years. Both the Economy Ministry and Central Bank flagged the danger of lower oil prices, which could cause problems for the federal budget. From the Reuters publication.
An increase in global oil production and falling prices would mean a sharp decline in Russian governmental revenues. Experts predict that, as usual, social spending will be the first to face budget cuts. Reported by Serhiy Kulias, Yulia Granovska, UATV News. Due to a sharp rise in spending, Russia's federal budget deficit has surged 14-fold compared to January 2024, already exceeding the planned shortfall for the entire year, the Moscow Times reports.
In January, expenditures, according to preliminary estimates, were higher than revenues by 1,710 billion rubles, or 0.8% of GDP, compared with the budgeted deficit for the year of 1,170 billion rubles, or 0.5% of GDP. A year ago in January, the budget was implemented with a deficit of 124 billion rubles, writes the Moscow Times.
Since Russia's full-scale invasion of Ukraine, its budget has consistently run at a deficit of over 3 trillion rubles annually, around 2% of GDP. To cover the gap, the Finance Ministry has relied on domestic borrowing and withdrawals from the National Wealth Fund, the liquid portion of which has already been reduced by 2/3.
Despite further increases in spending, the Finance Ministry aims to shrink the budget shortfall to 1,170 billion rubles, or 0.5% of GDP this year. However, these optimistic projections rely on expected revenue growth from tax hikes on businesses and citizens in 2025, as well as cuts to social spending in real terms, writes the Moscow Times.
Experts warn that Putin's determination to continue the war against Ukraine is draining Russia's finances. Official figures put inflation at nearly 10% as of February 2025, but economists estimate the real rate to be twice as high. Meanwhile, the Kremlin downplays the crisis, calling inflation, labor shortages, and rising prices temporary difficulties.
The Kremlin continues to conduct an information campaign likely directed toward both domestic and international audiences that aims to conceal the extent to which Russia's protracted war against Ukraine has negatively affected Russia's economy. Ms. Houston and Putin notably did not mention how the Russian central bank raised the interest rate to 21% in October 2024, or how Russia has been drawing from its National Welfare Fund to finance its war effort over the last 3 years. The liquidity portion of Russia's National Welfare Fund may run out by fall 2025, from a report by the U.S. Institute for the Study of War.
The war is draining more and more resources from Russia's civilian economy, leaving ordinary citizens to bear the cost. According to Federal State Statistics Service, prices have risen nearly 10% in the past year, with future increases expected. Major dairy producers have already warned retailers of upcoming price hikes of 7 to 10% in February.
Data from Romir suggest that real consumer price growth is between 20 to 30%. This is galloping inflation. The situation in Russia is clear. Inflation is out of control, creating major problems for the Finance Ministry. The central bank tried to portray the fight against it using market-based tools. The central bank still believes that there is a market economy in Russia. They raised the rate, which is a classic tool of market economy. But it doesn't work. No rate hike was implemented in December or February because it has no effect on inflation. Instead, they will resort to harsher measures, directly restricting loans to Russian businesses.
As a result, Russian businesses are already struggling with a severe working capital crunch. In the first 3 quarters of 2024, 16% of companies faced financial difficulties. By the end of the year, that number had risen to 25%, with no improvement in sight. Experts predict further inflation spikes and GDP growth slowing to just 1.5% in 2025. Earlier, CNN reported that Russia's worsening economic situation could force dictator Vladimir Putin to negotiate sooner than expected. Reported by Sergei Kudas, Yulia Granovska, UATV News.